Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, I'm going to have a chat with Chris. Chris is the CIO and partner driving Ascend Interplay, a RIA that manages assets for ultra-high net worth families. And we're kind of jumping into a little bit of a different format. Usually, Chris has been doing these market advice bits. Market updates bits where he's talking about interest rate shifts, what he sees going on in the economy, geopolitical concerns. Today, we're going to kind of go down and pull a thread on one of the concepts that he's faced with a lot. And it's a very important one. It's diversification. I think it is generally thrown around a lot and generally misunderstood, even by fairly sophisticated people. I think the understanding risk and how it applies to things varies actually by liquidity requirements. And so there's different measures for different parts of the capital stack for an individual. But today we're going to talk about what's called the endowment model and looking at a pool of very illiquid assets and how to think about diversification and risk management within that. So if you're into finance wonky stuff, hopefully it's helpful to you. We nerded out in this conversation and enjoyed it. And I hope you do too. Enjoy. All right. Welcome back, Chris. Good to see you, buddy.
Good to see you.
Okay. We're going to do a little different format today. Usually you're kind of giving us a rundown on the state of affairs in the financial side of the world. I wanted to do a through line on diversification. It's something we talk about a lot. It's a bit abstract, certainly nerdy, but I think it's a topic that a lot of people probably could benefit from. It keeps coming up. I think people in a lot of groups I'm running in think about risk in very different ways and how to measure it and assess it. And it seems like there's a lot of fairy tales, rules of thumb that are guiding very sophisticated people, and they don't seem to be grounded. So first off, if you're cool with it, I'd love to start by talking about kind of one of the core pieces of what we're doing here on the Ascend side of the house is the endowment model style investing for growth capital. Could you just introduce that and frame that? Maybe a little history of the David Swensen thing and kind of articulate what that is. And so we can talk about diversification on that side of the house from that lens.
Yeah, sure. So I'm going to take this in a more casual way and talk about it and like as if I'm talking to other CIOs. I'm not going to go full academic on this. But broadly speaking, when we talk about people refer to the so-called endowment model, there are really two layers of meaning. The first layer is that, and this is basically popularized by what you meant, David Swensen, Yale Endowment. Basically a more focus and more lean towards alternative asset investing. So things like private equity, venture capital, real estate. These asset classes traditionally were not part of the world's biggest hedge funds, for instance, and the focus is very much on public equities and fixed income asset classes. There are a lot of reasons for their way of investing because these assets are more liquid and certainly more measurable. And which is necessary for a lot of these institutions. But for an institution like an endowment, whose distribution schedule is very well defined, they know what their liability is to the university on a year-by-year basis, and it's not a lot. So, which means they can be a more patient investor for the long run. Not to mention they have a lot of access to the best opportunities in the private asset world. For the past 10 years, they've been shifting gradually more and more towards private asset investing. Okay. And that's the first most basic layer of endowment investing. But really, if you just look, you sort of look behind the curtains and what's really happening. It's really happening on an asset allocation level. So traditionally, if anyone listening to this is familiar with modern portfolio theory, CAPM. You probably heard of mean variance optimization, and classic endowment asset allocation is basically a variance of the so-called mean variance optimization. And all that means is you're trying to maximize the overall portfolio Sharpe of all the investments across private and public, by, and very importantly, by basically capturing as many uncorrelated assets as you can, big assets. And of course, the correlation part is something we can delve into later on. It factors in a big way in the style of investing. And what you're trying to do is really construct a portfolio with uncorrelated returns so that in good times and bad times, the portfolio can perform and ideally outperform just the generic public benchmark.
Okay. So you've got these endowments that got to fund a pretty small liability to keep the operations going relative to their asset base every year. And as a result, they can take longer term risk. And in theory, the way the market's supposed to work is there's an illiquidity premium. People call it liquidity premium, but I think it's like an illiquidity premium. Where if you can't get your money out like you could selling the stock, the idea is that you get paid more for that, right? You get paid a higher return to do something, to put money tied up somewhere, which is just intuitive. You got to have a better deal in one way or another if there's less attractive components to it.
Exactly.
Okay. So you've got a lot of major universities now, insurance organizations, pensions. A lot of them have adopted what's called this endowment model. There's opinions that are strong on both sides, and you get into the community of people who live and breathe this. But this is one of the basic conversational points in this part of the finance world. Okay. We're doing that for a lot of individuals, the individuals in the Ascend platform, for families. Mm-hmm. We're building for long-term assets that can be illiquid. We're building, and for the families that it's appropriate for, we're building this endowment model. So one of the questions that comes up that I think is very interesting, and one that I think a lot of people don't have their head around, is when you are in a situation where a pool of capital can be illiquid, meaning you're a university where you don't need that money soon, or you're an individual where it may be money that's long-term money. You don't know if you're ever going to spend it. Mm-hmm. A lot of people, when they talk about risk, their default KPI that they're thinking about is volatility.
Yeah.
Right? Stock market volatility. Well, you're looking at how much it went up or down in different periods of time. Is volatility the right and or even a relevant measure for this asset bucket?
Yeah. Very great question. That really is the core of, how we think about asset allocation for these, let's call it ultra high net worth families. To your point, these families, there's been a debate around this for a while, is what's the best way for them to think about risk and think about long-term return. And you're definitely right in that a lot of the assets, a lot of the liquidity that these families have, they don't necessarily need it for a long time, and their liability is very defined, just like an endowment. So it makes a lot more sense for these families to follow endowment style investing and asset allocation, as opposed to like a hedge fund, where liquidity is a major concern because redemption can happen any day, and especially when market is downturning. So it makes total sense. And of course, by doing this, you're, like you said, able to capture this illiquidity premium over time, which if you just simply comparing the private equity benchmark versus public equity benchmark over 20 years period of time, this illiquidity premium seems to be about 5% a year. And compounded over time, that's very powerful. It's a major difference. Now, to answer your question more directly, volatility. So in my view, volatility is not a great measure of risk overall, not even for public assets. It overemphasizes this so-called path-dependent way of investing, because an asset class, in very simple logic, a volatility capture is basically standard deviation in statistical terms. It captures both the upside potential and the downside potential on any given period of time. Now, anything going up is a good thing. As an investor, anything going down is a bad thing. So it really doesn't reflect, it only reflects maybe too much of the picture. You really only want the downside exposure. That's number one. Number two is, if your investment horizon, and for a fact that's true, is let's say 5, 10, 20 years, and ultimately your goal is to maximize your net worth by the end of that journey, it's less relevant to you how it moves on a year by year basis between now and then. It still matters in a big way, and I'll talk about it because, in the world of investing, I always say this to the team that what matters is geometric mean or compounded return, not arithmetic mean or averages, right? So if the link between the two is basically volatility. So the higher the volatility, the bigger the difference. So the lower the geometric mean or compounded return over time. So in that sense, it definitely matters from a long-term investing and maximizing return perspective. But as a measure of risk, it's certainly not perfect, and it really doesn't capture most of the risk that we want to diversify away anyways. Things like that I'm sure we'll talk about in private assets alone, unique risk points like manager selection risk, and it doesn't really capture at all the liquidity risk. It doesn't capture sort of the correlation factor among different asset classes. It doesn't capture your maximum drawdown as much. All these things are not reflected in that number. So I would not use that certainly as a benchmark for risk in the endowment style of investing.
Yeah, I think the interesting thing about volatility, why people get stuck on, is when they've heard about it, right? If they're exposed to finance, but maybe haven't been living in the investing trenches, so they've heard about it. They know volatility is bad, and I think if you're watching your portfolio go up and down, if you're thinking like liquid assets that are mark to market all the time, like a stock market, your stomach goes into knots when the market crashes.
Mm-hmm.
If you don't watch it, all you really care about is what you put it in at, what it comes out at, right? In theory, it's that simple. And so all of the movement along the way doesn't matter. And I think if the thing that was a key unlock for me on this concept was realizing that there might be pools of capital that you may not have to liquidate on a moment's notice if you budget properly.
Yeah.
And so the idea that it getting low for a period of time on a way to a greater height doesn't matter as long as it hits that height at the time you expect, right?
Yeah.
But if you might have to sell at a moment's notice, then volatility is really relevant. So I think it applies in some buckets, but it's a very interesting thing because I think most people I'm talking to, they're thinking about the volatility of portfolios where it's not, they're okay with it being completely liquid. It's kind of like, it's not the right conversational topic. Okay. Dalio's got this great video on YouTube. If folks haven't seen it, they should, we'll put it in the show notes. They should go watch it. And he does some statistical analysis, and he talks about how you only need a certain number of uncorrelated assets before additional diversification is essentially meaningless. Mm-hmm. I don't remember the exact number, 11, 12, 14. But by the time you got to the 15th or 12th, whatever the number was, adding the additional next uncorrelated asset didn't really reduce overall risk of the portfolio. So it was diminishing return. Now, his model presumed uncorrelated assets exist.
Yeah.
And I'd love to hear your take on the extent to which assets are correlated and how that shapes the way we think about the right level of diversification.
This is a great point to get into, and this is the biggest thing to really demystify among a lot of investors. So the first part is, does true uncorrelated assets exist in this our current macro environment? What I would say is, let me just give you an example. So historically, let's pick two asset classes: fixed income, public equity. These two, historically, the 60-40 portfolio. Everyone's been using these two asset classes in their retirement management. All the big investment firms are doing it. And the assumption on these two asset classes that they're negatively correlated. Okay, when you have negative correlation, it's even better than zero correlation when it comes to minimizing risk in your portfolio. However, if you look at data in the past 2 years, there's a convergence of the movements of these two asset classes. Part of it is because, and this is very easy to reason. Number one is in a market downturn, correlation gets completely blown up. So most asset classes start to move in tandem. Historically, when the Fed doesn't come in and rescue markets as much as they did in the past 15 years, 20 years, fixed income, most people will take their money out from equity and put them in fixed income. So the asset price on fixed income prices will go higher, right? Hence the negative correlation. But since the zero period started, so the zero interest rate environment started, and now, of course, we're in a hiking cycle and hopefully in a cutting cycle soon, correlation became much more aligned between these two asset classes. So instead of a negative correlation, people starting to observe, in fact, a positive correlation, somewhere in the low 20, 30%. Okay, still really good, but now it's moving in tandem. Why? Because you can imagine that during when the Fed is starting to cut, let's just give you a very simple example, when market crashes, the Fed comes in, starting to cut interest rates. And when you cut interest rates, of course, fixed income instruments, existing ones, the yield will go lower, and therefore price goes higher. But same thing goes for equity, because now your cost of borrowing goes lower, equity prices rally. So the two then go in tandem. The opposite environment is inflation. So inflation that we have been having in the past couple of years, the Fed starts to raise rates. So we're on a hiking cycle. In a hiking cycle, fixed income yield goes higher. So the price of the asset class goes lower, which is what we've been observing really across the board, looking at treasuries, for example, during 2022, 2023 crash. Now, same thing goes for equity, because again, cost borrowing goes higher, your risk premium needs to be adjusted, and equity prices comes down. So it's very easy to see why the correlation have increased because of the government's involvement in the free market. On top of that, these crashes become more and more violent, and the rally back, the recovery also becomes more and more violent. Part of that is also fueled by the fact that the correlation of these asset classes are now basically together. So all that is to say, uncorrelated assets are very, very, very difficult to find. They do exist, but the pockets where they do exist, maybe that the overall deployable asset base is not even big enough to cover the endowments of the world. It's very small pockets here and there, and it's very difficult to find. Most of the asset classes we can find are somewhat correlated. The correlation numbers tends to be between, let's say, 20% or anywhere up to 60%. That's the bucket you will consider somewhat correlated and still good potentially to add to your portfolio as a diversification factor. Anything above that, then you're really running the risk of, you're not really dissipating your idiosyncratic risk in your portfolio. The last thing I'll say about this, and this is really, really important to cover, is how, mathematically speaking, I'm not going to talk about the formula, but I just want to cover the overall concept of how to think about how much uncorrelated assets you want to add to your portfolio. What is that? What's the linkage between correlation and the impact on your portfolio return or risk reduction? And to talk about this, and this is mathematical. There's nothing made up about this. If you believe in modern portfolio theory, this is a hard fact. Is if you, as long as the Sharpe ratio, and Sharpe ratio is defined again by the risk premium divided by basically the volatility of the underlying asset class. Okay. As long as the Sharpe ratio of the asset class you're looking at is greater than the correlation between that asset class and your existing portfolio, multiplied by your existing Sharpe ratio of your portfolio. Okay, this is a very simple mathematical formula. As long, again, I'm going to reframe it. As long as the Sharpe ratio of the new asset class you're looking at, you're reviewing whether to add to your portfolio, is greater, even if it's marginal, than the correlation multiplied by the existing portfolio Sharpe. Okay, as long as that relationship exists, mathematically, by adding this new asset class, it will improve the Sharpe ratio of your overall portfolio. Okay. And you can look at this in two different ways. You can hold the denominator constant and say, oh, it will improve the expected return of the portfolio. Or you can say, if holding the expected return constant, it will reduce the risk in your portfolio. Okay, it's that simple. It's very elegant and very simple. And overall, it's very true.
I love that you're articulating formulas of formulas and calling it simple. All right. Bringing this up a level, though. Yeah. We've got diversification in a universe where assets always have some degree of correlation. I remember when I got into venture and I was first starting, I was like, oh my God, we have nothing to do with the public markets. I don't care what they're doing. I'm investing in a company that might IPO or do something in 9 or 10 or 11 or 12 years. And that was extraordinarily naive. This is 20 odd years. This is going on 20 years ago.
Yeah.
The amount of connection between the venture market, which are these private assets that are long holds, is so significantly felt by the venture community when the market shifts. Yeah. It changes how much companies are acquiring companies. The public companies, how much access to capital they have, so how much they're going to be acquiring. It changes the number of IPOs happening, which changes the amount of liquidity the LPs are getting, which changes the amount they're deploying into new funds. It's interconnected wildly. So we're living in this world of connectivity where there's not a lot of truly uncorrelated assets.
Yeah.
So Dalio's model, which I know he knows was academic, was showing a universe where you only need a dozen or so truly uncorrelated assets to kind of diversify away material, idiosyncratic risks. In a correlated world, how do we think about, like, a rule of thumb? What's a simple way to think about the right amount of diversification?
Yeah.
Is there a simple way? What's the volume as we're out investing in funds and taking positions? Is it 10, 20, 50, 100, 300? What is it?
Yeah. And that is really difficult to pinpoint. But as a rule of thumb, as you mentioned, if you're investing in the private world and the public world, of course, you want to have exposure across multiple asset classes. But if you're constructing a portfolio in just private assets between direct and funds, you really want to hold somewhere around at least 50 investments in your portfolio. And that sounds crazy to a lot of people. That sounds definitely a difficult task to accomplish in a short period of time.
Most people, the rule of thumb is that's insane.
Yeah.
I've had a lot of adverse reactions when I talk about our portfolio breadth.
Yeah.
And I think people are thinking, how do you find that many good investments? Or how do you do your proper diligence? Or you don't need that much diversification to manage risk.
Yeah.
But I know our view is that things are correlated. So we got to have a bigger portfolio. So please. Okay. So we're talking 50.
Yeah. We can talk about this for hours. Why that's probably the right number. It has to do with, number of investments per asset class we think are minimally sufficient to maintain some diversification. Of course, we're talking about funds. So each fund has their own diversification within the fund. And it's difficult to say how many ultimately the underlying assets. You want to get to basically in over 100 and 200 probably if you're doing a look through those funds and look at the ultimate underlying pool of assets. But what I want to highlight here is you're people who are arguing the other way are not incorrect, because this is a balancing act. You want diversification to get rid of idiosyncratic risk, but at the same time, you want too much diversification. Basically, it means you have an index fund. Okay, you're just capturing the beta of the portfolio. There's minimal alpha left. You want to. There's a balancing act between the two, where there's sort of a sweet spot. What is not considered an index fund? This ultimately has to do how many asset classes you think on a portfolio level you're going to get into. Okay, if you're just going to be in venture or in private equity alone, you might not need that many potentially to reach the optimal in the balancing point. But if you're investing across the asset classes, you want to have hedging on an asset class level, on a portfolio level. Then you construct it from the ground up. You look at how much minimum you need from per asset class. By the way, it's not just asset class we're trying to diversify, right? It's also geography. It's also stages. It's also manager risk. It's so many different diversification points that we want to hit. So overall, all that comes down to around 50 for the families that we're, of course, helping to construct a portfolio.
Yeah, and there's this juggling also on the other side, just the operational management of it. There's a finite amount of resources to get work done and have a good throughput.
Exactly.
So,
it is not, you're not supposed to
for any management
overnight. Exactly. It's a 2 to 3 year effort. And that in itself is diversification across vintages in private assets. So, and each cycle, if you're thinking about business cycle as a 10-year cycle, then really 2 to 3 years is still a fairly small part. I will argue that that's even a little bit still concentrated. So you want to reinvest the capital that you collect, the distributions you collect from these assets back at the next cycle, right? Every 2-3 years or so. So to really create that diversification impact. But so it's definitely not an overnight effort.
To bookend this conversation, we started with Swenson. We'll end on a question from him as well. One of the things he brought up, when he was kind of laying out this thesis, was that when you're doing this type of illiquid asset allocation, if you run the risk-adjusted analysis across a lot of these types of funds, it's not worth it.
Mm-hmm.
Right? It's not worth it to construct these portfolios if you're getting kind of the mean private equity return or the mean venture return. What he concluded was it's highly worth it if you're good at manager selection.
Yep.
So when people are kind of setting up to think about this, how should they think about what position they need to be in to go and endeavor into a 50 fund portfolio?
Yeah, great question. So I'm in line with David Swenson on that. And you really need to capture, the goal here is to capture at the bare minimum, top quartile return across venture, private equity, real estate, private debt, these asset classes, to really make it worth your while, especially after considering the capital call schedule that you have to manage along the way, all the work that goes into that, the lack of liquidity, of course, as we talked about, the tax implications, and all of these things. And by the way, currently we're in a high interest rate environment, which means cash management is actually quite okay. People are getting 5% yield as we speak, but when we go down to zero, then managing capital calls becoming very, very costly from a opportunity cost perspective. So, but to do this right, you need the right amount of access. You need to be confident that selection bias is not at the center of this thing, right? You need to have a mechanism in place, a pipeline, a proprietary enough pipeline in place to source top quartile opportunities. And by the way, to have a structure, an internal thesis around each of these asset classes so that you can pick, when it comes to, every person sees tier, if you're good enough, you see still tier 1, tier 5 opportunities. So once you open up that channel, the pipeline, you still need to be able to pick the best ones from the pile. And by the way, it's getting more and more difficult because a lot of these, the top performers are now still shifting. This is not a secret that top performers tend to be in the more emerging bucket of each asset class. Due to motivation and the maybe smaller set and more niche opportunity sets. But in the emerging manager world, there's so much to sort through. There are so many things, and maybe lack of track record, and it's a lot harder to diligence. So it's not easy. You need to have the right amount of access, a lot of diligence work, a core thesis and pillar sort of around each asset class, investing thesis, with the right amount of experts around you to help you, guide you, and catch the red flags. And then on top of that, diversification, right? And following a plan of attack, which is asset allocation model, and then have the right tactics, which is how to pick within each asset class. All these things have to fall into places for you to be able to actually capture the top quartile return.
Good insight, my man. Thank you, Chris. Appreciate this.
Always. Thank you. Appreciate talking to you.
Just a quick reminder for everybody, Chris runs an SEC registered RIA, and nothing he said should be misconstrued as investment advice. All right, everybody. Thanks for listening. Chris is a mastermind on this stuff. So smart. Very cool to hear his perspective on it. We bat this stuff around a lot internally. And the reason why I wanted to cover it on the pod was just I think there's a lot of misunderstanding of how to talk about and think about and manage risk. And there's some wisdom to share. So hopefully that's out there. And this is helpful to folks. And we will catch you on the pod very soon.